We have two talks today in our session. The first one is about the sort of Basel III European standard of assessing assets and how that would help us to prevent another global financial crisis. So this became quite popular after the 2008 credit crash and the subsequent default of Lehman Brothers, and now there is a lot of action from the European improve the risk management practices at banks and other financial institutions. So Yana Georgieva from University of Nottingham will talk about that.
So my name is Yana, and today I'm going to discuss the potential of the Revised Capital Adequacy Standards and the Basel III to prevent and mitigate another global financial crisis. Right, so outline, I'm going to make a brief historical overview of the Basel International Regulatory Standards, the three revisions, Basel I, Basel II, and Basel III. I'm going to touch upon the nature of financial crisis in general and discuss the causes of the most recent financial crisis in specific, and finally I'm going to discuss the potential of the latest revision, Basel III, and whether it holds the solution to the inefficiencies of the international financial system. So just some background information. So the Bank for International Settlements was established in Basel, Switzerland in 1930 as the first semi-public international bank. It was designed to be a bank for central banks. The Basel Committee on Banking Supervision was founded in 1974 under the aegis of the Bank for International Settlements and by the central bank governments of the G10 countries. In fact, the Basel Committee is the most prominent de facto regulatory body in the international banking system. It's important to emphasize that it formulates soft law instruments, in other words, they're not legally binding, and they're transposed into each jurisdiction for national legislation. Right. So the first Basel Accord, commonly known as Basel I, was promulgated by the Basel Committee on 15 July 1988. It addressed almost entirely credit risk and was not particularly sophisticated. Subsequently, it was complemented by market risk rules, and it introduces a two-tier framework for the calculation of capital adequacy. The minimum bank capital ratio was set at 8%, equally divided between 8% of risk-weighted assets, equally divided between Tier 1 and Tier 2 capital. Major criticisms of Basel I, it is said to encourage banks to make high-risk investments that may contribute to cyclicality over the business cycle, which may result in an understatement of the risks involved and overstatement of the bank capital adequacy. This may lead to moral hazard, reduced lending, and ultimately may engender credit crunch, like it happened in 2007. So also another major criticism of Basel I is the fact that the input side representation during the formulation of the standards was highly exclusionary, mainly representing Western country interests. Structural changes introduced by Basel II. This is the first revision of the standards. It was promulgated on 26 June 2004. It introduced, basically retains the basic features of Basel I, but introduces a three-pillar structure. The first pillar consists of a revised set of minimum capital requirements. The second pillar refers to supervisory review process, and the third pillar relates to public disclosure and market discipline. It's basically intended to penalize for risk management practices in the banking sector. Right, all credit market and operational risks are on the agenda of the revised system. And also an important point, there is a new consolidated supervision approach to the capital adequacy of internationally active banks. This basically means that internationally active banks are going to treat as an integrated whole, because this is one of the major loopholes of the Basel I regime. Banks were allowed to transfer assets to subsidiary companies, and in this way systematically assuage to the capital adequacy requirements. Major criticisms of Basel II. It is said that the Basel II regime envisages more discretionary powers unless supervision by regulators in respect of larger banks. Also, it is said to have an intricate structure and very high cost of implementation, which poses a particular problem for developing countries, and consequently it reduces the impact of the accord. Right? Also, the Basel Committee has for a long time had reputation for international European judgment. So there are concerns about policy capture, dominance of Western country private sector financial interests, potential resource impact on competition and procyclicality. Structural changes introduced by Basel III. This is the latest provision. It's important to mention that by 2008, 17 new countries joined the organization. This significantly broadened its perspective. I'm talking about the Basel Committee. So it is an expanded Basel Committee that agreed on the details of the latest framework, Basel III. It does not change the overall capital adequacy framework. It retains the three-pillar structure of Basel II. But it has changed focus. It's mainly concerned with capital definition and the minimum percentages required of banks, rather than the definition of risk-weighted assets. Key reforms. I'm going to touch upon all four of them. First, it is raising the quality, consistency, and transparency of the capital base. Basel III envisages a material augmentation of the capital base, much higher minimum capital requirements than pre-crisis levels, significantly narrow definition of capital, tightened criteria for both Tier 1 and Tier 2 capital, and it basically abolishes Tier 3 capital. Creation of capital conservation buffer is intended to support the conservation of capital and the build-up of capital buffers during periods of strong economic growth. And the related counter-cyclical capital buffer constitutes a tool granted to national regulatory authorities, conferring them the discretion of how to add an additional requirement of up to 2.5% of risk-weighted assets during periods of strong economic growth. Discretionary power, that's discretionary power. Enhancing risk coverage. This is the stress value at risk capital requirement. It's intended to broaden the risk coverage of the capital framework. Major reforms, leverage ratio requirements and liquidity rules. The leverage ratio is calculated on the basis of the new narrower, more restrictive Tier 1 capital definition. It's intended to restrain banks from excessive risk-taking and excessive leverage accumulation. Liquidity rules comprise liquidity coverage ratio and net stable funding ratio. The introduction of liquidity rules is said to be the most significant addition to the Basel standards. The liquidity coverage ratio is designed to improve banks' short-term resilience to potential liquidity disruptions. It entails a requirement that banks should have at any time unencumbered assets sufficient to meet their liquidity needs over a 30-day horizon. The net stable funding ratio is designed as a longer-term structural liquidity ratio meant to provide incentives for banks to use stable funding sources in general. Addressing systemic risk and interconnectedness, it is contended that the new Basel III framework, generally the new capital requirements serve to help in this respect, addressing systemic risk and interconnectedness. For example, there are capital incentives for banks to use central counterparties for over-the-counter derivatives. Now, financial crisis and roots of the most recent global financial crisis. First of all, it's important to observe that the natural economic cycle comprises alternating periods of high growth and increasing asset and commodity prices, and periods of low growth and decreasing asset and commodity prices. In other words, crisis may be seen as being inherent to the business cycle and to human nature itself. So, like what we put it, there may be the price one must pay for the efficiencies of the market system. But globalization has significant role here. It has been observed that in the past 25 years, crises have occurred with abnormally high frequency, and this has been attributed to increasing internationalization of the financial system. It is said to have had a clear prejudicial effect on global financial stability, with especially pernicious consequences for poor and severely indebted nations. Right, and then principal causes of the most recent global financial crisis, three main headings: improper regulation, over-leveraging, and perhaps financial globalization. Regulatory deficiencies, well, one of the key hallmarks of the global financial crisis has been the lack of regulatory and supervisory integration at the international level. Risk of regulatory arbitrage. It has suggested that the risk-weighted system of the Basel requirements promotes, or at least provides incentives for regulatory arbitrage. And over-leveraging and engagement in conventional business practices, the accumulation of high leverage in the pre-crisis period and the concurrent erosion of the qualitative capital base have been identified as one of the major causes of the financial crisis. Right, and there is an important point here, the too big to fail phenomenon under all the global systemically important banks. There was the perception that the larger the systemic importance of a banking institution, the more likely it is that it will receive financial support in order to avoid system-wide negative repercussions. So this led to moral hazard, depriving the market of its inherent powers to impose discipline and to make banks take sound investment decisions. Also, a related point that global systemically important banks shifted their focus from their traditional lending functions to creditworthy borrowers to non-lending economic activities. Namely, they engaged in the engineering of unconventional assets. So the combination of the build-up of excessive leverage and the move to unconventional business practices were both strongly conducive to the system-wide systemic shock. Globalization. Globalization has both brought benefits, but also it has major downsides. Risks spillovers from national, regional, global crisis. It lacks some of the punitive protections of national systems, for example, lender of last resort, financial regulator, and so on. And for this reason, it's less stable and more prone to descend into acute crisis. So, last but not least, Basel III, the last revision, does it hold the solution to the inefficient groups? Okay. I'm going to put forward some arguments supporting the suitability of the Basel III standards and arguments undermining the suitability of the Basel III standards. First of all, strengthened capital framework. It is generally argued that raised capital and liquidity requirements should, in theory, reduce the probability of large-scale crisis and increase the overall economic welfare. And also the reinforced infrastructure for market supervision is supposed to help. Improved risk management. Basel III places emphasis on the oversight of senior management as a crucial element. Before that, the focus was on holding shareholders accountable, whereas we can observe a shift focus towards senior management, oversight of senior management. Progress in the shadow banking system.
I'll just change this.
Right. So, in terms of arguments undermining stability, we're talking about the one-size-fits-all single global risk factor, which is allegedly labeled to calculate the credit risk existing in different businesses and different regions. And again, regulatory arbitrage, the fact that the Basel system provides incentives for circumventing the rules, which may lead to potential leverage expansion almost without limit and in a relatively inject manner. And impracticability of the counter-cyclical buffer. It's severely criticized in terms of its methodology. Concluding remarks. Well, despite the fact that Basel I and Basel II haven't been able to avoid significant financial crisis. Generally, there's broad consensus that the Basel courts in general constitute one of the most successful regulatory harmonization projects in the field of international banking. Regardless, of course, for instituting wholesale reform of the international financial system in the wake of the global financial crisis, its fundamental architectural edifice has been largely unchanged and been preserved. Global leaders have instead focused on making improvements to the current structure, in order to reduce the frequency and magnitude of future crises. And also, let's highlight again the broader perspective of the Basel Committee, the fact that we just recently joined by 17 new countries. So the question here is whether this movement towards greater transparency and wider representativeness will actually manage to overturn the strong private sector Western country interests within the organization. And there is a big drawback of Basel III. It assumes that governments and regulators can think better and faster than the economy and the market, and the question is if this is actually plausible. And also large banking institutions, global systemically important banks, they remain a serious concern. Limiting the scope of shadow banking and reducing the too big to fail expectation seems to be one of the basically transcendent prerequisites to the accomplishment of the Basel project. Or in brief, the fear of failure must return to banking.
Now we can take some questions.
Hi, well, thank you very much for the presentation. I have sort of two questions. Do you think one, after the 2008 credit crunch, do you think that sort of signified the absolute end or death of neoliberalism as an economic movement? Do you think that because of what happened, is now we're going back to Keynesian, we're going back to overregulation, we're going back to greater regulation? That's number one. And then number two is the fear of failure must return to banking. Do you think then in that case perhaps the Lehman Brothers or Northern Rock should have been allowed to go bankrupt and they should not have been bailed out and they should have been allowed to go under just to set a precedent where the banks need to be careful what they do because the governments will not bail out their actions on whatever happens?
Well, first question, I very much hope so that this won't happen because that's my personal opinion, but obviously interventionism now seems much more substantiated, much more well argumented than before the crisis. As to the second question, well, that's controversial. Like, this is an ongoing debate, so my personal opinion is that maybe they should have been bailed out, but no one can really tell.
I just would like to give my opinion here on the first question. So from what I've seen is that usually in economics people overreact when something happens. Recently banks are hiring risk managers at the same rate that they used to hire risk takers before 2007. So I think it's good to have good and robust regulations, but at the same time there needs to be some sort of balance between the two. There was one question. Yep.
So maybe my question is very naive. In general, how do you determine causality between, or at least the efficacy of policy on the effect on financial markets?
So causality between what? I couldn't hear you.
How do you in general determine causality or at least efficacy of policy on the effect and their effect on the financial market?
Simply put, if there is no financial crisis, then basically the regular conditions is more or less worse. No, I mean, is it that extreme? No, it's supposed to be that extreme.
I think